What a way to end the week. Stocks rally and rally big. The Dow Jones Industrial Average soared 440 points to 25,335. NASDAQ added 132, closing at a record. And the S&P 500 gained 47 after the monthly employment report for February turned out to be just what Wall Street hoped for. Wall Street and Main Street cheered the creation of 313,000 jobs, a lot more than expected, and a very steady unemployment rate of 4.1%. Wages were up, but not a lot, easing investor concerns about a rapid acceleration of wages and inflation. Hampton Pearson has more on the rosy jobs picture in America.
In February, employers went on a hiring binge, adding 287,000 new private sector workers to payrolls, on the way to the biggest monthly job gain in nearly 2 years. Construction led the way with 61,000 new workers. Professional and business services and retail each added 50,000 new hires. And manufacturing continues to rebound with 31,000 jobs. The unemployment rate remained at 4.1% for the fifth consecutive month because of a blockbuster increase in the size of the labor force, up 806,000, the biggest monthly gain in 35 years. Treasury Secretary Steve Mnuchin was encouraged by news of more job seekers returning to the labor force.
Everyone has said, aren't you concerned about inflation, given we're at full employment, and given the tax cuts and the growth in the economy? And my comment is, we're not really at full employment because of the participation rate. So I'm pleased it ticked up a little bit. That's a number that I'm very focused on.
But wage growth actually slowed down from previous months, up just 2.6% over the last 12 months to $26.75 per hour on average. Not the best news for Main Street, but easing market concerns about inflation and the Fed.
This economy seems incapable of producing scary inflation. I think that's the most important message here. That's positive for both stocks and bonds.
The next Federal Reserve meeting is less than 2 weeks away. One monetary policymaker says today's jobs report, with huge job gains and no sign of inflation, gives the Fed time to wait and see before raising interest rates.
My own preference would be to wait a little bit longer, let the March inflation, anomalous inflation rate from a year ago fall out of that. Let's make sure that these sort of Amazon disruptive kind of pricing models aren't continuing to find their way into keeping inflation lower than that.
There are economic X factors in the months ahead. First, the expected boost for both businesses and consumers from the Trump tax cuts. But perhaps the biggest speed bump, the coming tariffs on steel and aluminum and their impact on the job market. For Nightly Business Report, I'm Hampton Pearson in Washington.